Welcome to this explainer on Law 7582. It's a total game changer for corporate producer taxes. Let's dive in.
Get this, the tax burden for active producers just got slashed in half, literally down to 12.5%. Sounds absolutely incredible, right? But who actually gets to claim this historic advantage, and when does it start?
Look at this stark contrast. The standard 25% rate is plummeting to a super favorable 12.5%.
Now, the timeline's kind of tricky. The law passed in June 2026, but it only applies to 2027 earnings.
So you won't actually feel that financial relief until your 2028 tax declarations. Make sure you plan accordingly.
To qualify, you've got to meet specific conditions. Having a fancy certificate on paper just isn't going to cut it.
First, hold a valid industrial registry certificate. Second, prove you're doing actual physical manufacturing. That's the key.
And here's a really cool twist. Corporate agricultural producers are fully included in this massive tax relief program.
But wait, there's a catch. You need to visualize your balance sheet with two completely distinct income lanes.
Why? Because the discount applies exclusively to production earnings. It sets up a complex dual rate system for you.
For example, any financial income your company makes, that stays locked at the general 25% rate.
The exact same strict rule applies to rental income. It gets zero benefit from this new production discount. You also have to navigate the double deduction ban. No stacking multiple incentives on the exact same profit.
Meaning you definitely can't claim both this new production discount and the export discount on the same earnings.
Just a heads up, this new mechanism is totally separate from those older 1 to 5 point manufacturer discounts.
All right, this brings us to a massive accounting trap: allocating shared expenses across that dual-lane balance sheet.
You must meticulously split shared costs like management, electricity, and HR between your production and non-production lanes.
Messing this up artificially inflates your discounted profit, and that leads straight to severe tax evasion penalties. Ouch. The tricky part? We're still waiting on secondary regulations to define the exact distribution keys for those expenses. Which leaves us with this final, critical question. Is your company truly ready to separate these expenses flawlessly?